Have you ever looked at your investment portfolio and seen these mysterious things called ETFs, tracking indexes like the S&P 500? You might wonder, how does that actually work? It's not as magical as it seems. Let's dive in to understand exactly what's going on. Imagine you have a huge basket of apples, each representing one company. Now, imagine you need to check if these apples are still fresh, like checking the value of all those companies. Instead of counting every single apple multiple times, someone could just weigh the whole basket. That's kind of like what an ETF does for investors. The S&P 500 is a big basket containing representative stocks from some of the biggest US companies. An ETF that tracks this index gathers a little piece of each company in its own basket. But here's the surprising part. It doesn't literally buy every single stock. Okay, so let's dive into how an ETF actually works. You might think of an ETF as a basket of stocks that you can buy and sell on the stock exchange, just like any other individual share. But there's more to it than meets the eye. Here's what keeps your ETF in sync with its underlying index. Imagine you have a magical jar filled with different colored marbles. These marbles represent the companies that make up an ETF. Now, let's say this jar is meant to mimic the performance of the S&P 500 index. The S&P 500 is like a big basket of the 500 largest publicly traded U.S. companies. To keep your magical marble jar in sync with the real-world S&P 500, you need someone who can constantly check and adjust the marbles. This role is usually filled by an investment manager or an ETF sponsor. They ensure that the composition of your marble jar matches the S&P 500 as closely as possible. Here's where it gets interesting. Instead of using a physical jar full of marbles, the investment manager uses something much more efficient, called an order book. Think of this order book like a recipe for your ETF. It lists all the stocks that should be in the basket and their exact weights or proportions. And here's the surprising part. The order book isn't just written once. It's constantly updated by market makers, who are essentially like chefs who ensure the recipe is always followed correctly. These market makers buy and sell shares of the ETF throughout the day to keep its price close to the value of the underlying index. So, when you hear someone say ETFs track their indexes, they mean that there's a team of people behind the scenes making sure your magical jar stays in sync with reality. By doing this, ETFs provide you with a convenient way to invest in an entire market or sector without having to buy every single stock yourself. Okay, so you've heard that ETFs just track an index and don't need much management, right? Well, hold on to your hats because there's more to it than meets the eye. Most people believe that ETFs are passive and self-regulating, but in reality, they're actually quite active. And here's the surprising part. Fund managers play a crucial role in ensuring an ETF stays true to its index. They do this by constantly buying and selling the underlying assets within the ETF basket. Think of it like a real-life game of Jenga, where you have to keep the tower stable even as pieces come and go. Let's take a simple example. Imagine you're building a Lego model that represents an ETF tracking the S&P 500 index. At first, all the pieces fit perfectly, representing the top 500 US stocks. But over time, companies get bought out or listed on new exchanges, or they might fall below certain thresholds and get dropped from the index. The fund manager's job is to make sure your Lego tower, representing the ETF, continually updates to reflect these changes. They do this by constantly checking in on the composition of the S&P 500 and purchasing any missing pieces while selling off those that are no longer part of the index. It's like a dance where the fund manager has to keep the rhythm going, making sure all the right blocks are in the right places at all times. So remember, even though an ETF might seem like it's passively following an index, there's actually a lot of active management happening behind the scenes. That's why you often see different ETFs tracking the same index, but performing slightly differently, because their fund managers operate on somewhat different strategies and time frames. Now that you understand the active role of fund managers, let's dive into how an ETF actually tracks its index. Imagine you and your friends decide to form a group project in school. But instead of just doing it yourself, you want to replicate exactly what the top students are doing. And here's the surprising part. Most ETFs use a method called passive replication to mimic the performance of a particular index or set of assets. This is like following each friend individually. Each stock or bond in the index follows its own price movements, and your ETF mirrors those movements as closely as possible. But some ETFs might have an active manager who makes decisions on which stocks to include or exclude based on their judgment. Think of this as delegating someone else to keep an eye on your friends and make sure everyone's performance is on track. Active managers can be helpful in specialized cases, like when a market is unpredictable or volatile. However, most ETFs stick to passive replication because it's more efficient and typically less expensive for investors. It's like having a map that tells you exactly where to go rather than trying to navigate blind. So, how does this work under the hood? Well, an ETF will have its portfolio closely aligned with the underlying index it's tracking. This could be something like the S&P 500 or NASDAQ. The fund manager buys and sells assets in the portfolio as needed, ensuring that the overall value of the ETF stays close to the index. And here's another surprise. Even with passive replication, there can still be some small differences between an ETF's performance and the actual index due to something called cash drag, which happens when the ETF needs to hold on to a little bit of cash instead of investing it fully. But overall, this method keeps costs down for investors. Okay, so far we've talked about how ETFs track indices like the S&P 500 by buying a little bit of each stock that's part of that index. But here's the really surprising part. This is only half the story. The real magic happens when big investors are involved. Imagine you have a huge piggy bank filled with all sorts of toys. Now, let's say you want to create your very own mini piggy bank, but you only have space for a few specific types of toys. Instead of taking out every single toy one by one, wouldn't it be easier if someone else could just swap their collection of those exact toys for the slot in your piggy bank? That's kind of what happens with ETFs. Here's how it works. Big investors, usually financial institutions and fund managers, can ask to trade a basket of stocks directly with the ETF. They give the ETF manager all the stocks that make up, say, half of the S&P 500 index. In return, they get new shares of the ETF. This process is called creation. And here's where it gets even cooler. This doesn't just happen once. If the ETF starts to drift away from its target index, these large investors can come in and do the opposite. Swap their ETF shares back for a mix of stocks that are part of the index. We call this process redemption. By doing these swaps, they ensure that the ETF always stays aligned with the index. So, it's not just about buying and selling individual shares. It's about maintaining the value of the entire fund by adjusting its composition through these big trades. This is why even when lots of regular investors are moving in and out, the overall price of the ETF doesn't get too far off from what it should be. So, next time you see an ETF tracking an index, remember it's a carefully managed process. These funds aren't just passive trackers. They're dynamic machines that work tirelessly to maintain their value. And here's the surprising part. ETFs don't just follow indexes. They actively manage them through something called creation and redemption processes. Now that we've peeled back the curtain on how ETFs really work, you might find yourself looking at them differently. But there's much more to learn about markets, trading, and investing in general. Understanding these mechanisms is key if you want to navigate the complex world of finance with confidence. So what's next? If you're curious about other market mysteries, like how leverage works or why cryptocurrencies are so volatile, there's a whole channel full of knowledge waiting for you. And if you found this explanation helpful and want to stay informed, why not give us a subscribe? After all, in the world of markets, being better informed is your best defense. If you'll never look at an ETF or even a plane the same way now, you know what to do.